Good morning, ladies and gentlemen. I trust all of you are doing well on this rainy Monday morning. Well, at least for those of you who reside in Gauteng. Welcome yet to another lesson for FAC2602. So as I've indicated, I will be preparing lessons as part of the exam preparation for those of you who will be writing the supplementary examination, also known as the second opportunity examination, on the 23rd of January. As far as I can recall, you guys should be writing at 12 p.m. So you still have enough time to prepare, and we will be starting our exam preparation lessons by working through, firstly, the October 2022 examination. So this was the exam paper that we have written on the 24th of October during that chaotic exam session. I'm sure a lot of you would want to forget that exam session, but all we can do now is move on and prepare as best we can for our second opportunity. All right, so we will first work through the October 2022 examination, and then we will work through the 2021 exam papers. Now, I have prepared and shared a set of suggested solutions for all of these papers on the Telegram group, so you can make use of those documents as well while you are watching each of these lessons. I'm sure that it will be to your benefit. All right, now, as with any other question in FAC2602, we always go to our required section first. All right. Now, for question 1, so in today's lesson, we will work through question 1 of this exam paper, which covers the pro forma consolidation journal entries. All right. Only certain pro forma consolidation entries are required. We are allocated a time limit of 19 minutes. So once you start reading through the information up until you finish the last journal entry, it should take you about 19 minutes. So please try your best to adhere to this time limit. Now, for question 1 in the 2022 or the October 2022 examination, the required section states that we are required to draft the following pro forma consolidation journal entries of the Valley Limited Group for the year ended 30 September 2022 after taking the above mentioned information into account. Now, you should notice from previous lessons where I have specifically addressed pro forma consolidation journal entries, the order in which the pro forma consolidation journal entries are asked will be in the same order as the given information. So, in context of this question, the first journal entry requires us to eliminate intergroup interest on the long-term loan. So you will find the information regarding the intergroup interest or the intergroup loan in either additional information point 1 or 2. All right, in this case, it was given in additional information point 2 because additional information point 1 only gave us general information that we will also need as part of our calculations. All right, so please take note of that as well. And then just before we start, we also have to pay attention to our please note section. Our please note section states that we do not have to provide journal narrations. So what this means is that we do not have to describe our pro forma consolidation journal entries. We just need to state which account is debited and which account is credited. And with each pro forma consolidation journal entry, we need to indicate clearly to which company each account refers. As always, we need to show our calculations, no matter how simple those calculations are. Round off all amounts to the nearest rand and ignore the taxation effect on unrealized profits, losses, capital gains tax, and dividends tax, because these will be addressed in Financial Accounting 3, the new FAC2764 module, for those of you who are studying accounting sciences. Okay, so let's not waste any further time. Let's start with question 1. Now, just before you process the first journal entry, Please indicate your current financial year, because the current financial year will help you to determine which accounts are affected, especially where you are dealing with an intergroup style of a depreciable asset. If the asset was sold intergroup in a previous period, we know that we will make use of the retained earnings account in order to eliminate the unrealized profit or loss, as well as to eliminate unrealized depreciation in respect of the previous period. So please indicate your current financial year. Now, according to our required section, the current year has ended on the 30th of September 2022. So this means that the year has started on the 1st of October 2021. And since we are drafting the pro forma consolidation journal entries for the Valley Limited Group, we know that Valley Limited will be the parent in this question, and the other company that they refer to in the information will be the subsidiary. In this case, it will be Rancho Limited. So Rancho Limited is the subsidiary, and Valley Limited will be the parent. All right. So now that we have determined that, we can actually start with the journal entry. So number A requires us again to eliminate the intergroup interest on the long-term loan for 3.5 marks. Okay. Now the information regarding the intergroup loan is given in additional information point 2, which says the following. Now, Rancho Limited, the subsidiary, obtained a loan from Valley Limited on the 1st of November 2021. If we look at this date, all right, we can clearly see that this falls within the current financial year, which has started on the 1st of October 2021. So we will be required to calculate interest on this loan for 11 months, because the month of October 2021 is excluded. Okay, the loan agreement was concluded on the 1st of November 2021, which falls within the current year. And from the 1st of November 2021 up until the end of this year, which is the 30th of September 2022, will give you a total of 11 months. All right, let's read further. The loan is repayable in 3 years and incurs interest at a rate of 10.5% per annum, which is payable in arrears. The interest of the current year has been accounted for by both companies. So both the parent and the subsidiary have recorded the interest on this loan. Okay, and since Rancho Limited obtained the loan from Valley Limited, Valley Limited would have received the interest on the intergroup loan. So in other words, what I'm trying to say here is that the parent has recorded the interest for the year in its other income, because they would have received the interest on the intergroup loan, because they are the ones who granted the loan to Rancho Limited. Okay, so Valley Limited granted the loan. So in other words, Valley Limited would have received the interest, and therefore they would have recorded it as part of other income. Okay, if you look at your two trial balances, so the trial balance for each company, we are only given the profit before tax amount for each company. Okay, but we know other income would be part of the profit before tax. Okay, so both companies have accounted for the interest, and Rancho Limited would have paid the interest, so therefore it would be included in its finance costs. Okay, which is also included in the profit before tax amount, or it has already been taken into account in determining the profit before tax amount. Okay, the interest does not qualify for capitalization and is expensed in the year in which it was incurred. Okay, that is in accordance with the accrual basis of accounting, which states that we have to recognize an expense when it is incurred and not when the actual cash flow for that expense occurs. Now, the interest does not qualify for capitalization, so we do not have to add the interest amount to the value of the long-term loan. All right. Okay, so what we are required to do here is that we have to calculate the amount for the intergroup interest for this year, okay, from the 1st of November 2021 to the 30th of, pardon me, from the 1st of November up until the 30th of September 2022, using the interest rate of 10.5%. So let us first do that. So for number A, intergroup interest for this year that we have to eliminate, because if you think about it, the group, all right, cannot pay interest to itself, which is why we need to eliminate the interest that was paid by the subsidiary Rancho Limited to the parent Value Limited. All right. We first have to determine the value of the loan. Now, if you go to your given trial balances, you will see that we are given the value of the long-term loan, okay, Value Limited, 180,000. So in Rancho Limited's records, it will be shown as a non-current liability, all right, because the loan itself is only repayable in 3 years' time. So therefore, it will be shown as a non-current liability, all right, to the value of 180,000. So in the parent's records, it will be shown as a non-current asset because the loan amount is receivable from Rancho Limited. So in the debit section, you will also find the long-term loan, which was granted to Rancho Limited, and it is also shown at the value of 180,000 in Value Limited's records. Okay, normally you would also eliminate these intergroup loan accounts against each other because they represent common items. Okay, but according to part A of this question, or question A, or 1.A rather, we are only required to eliminate the intergroup interest on the loan. Okay, but you should know that you must also eliminate the intergroup loan accounts against each other if you are drafting the group financial statements. All right, so the value of the loan is 180,000. The interest rate was given as 10.5%, and as I've indicated previously, we are calculating interest for 11 months rather, not 12 months, because the loan agreement was only concluded on the 1st of November 2021, so the month of October is excluded. So therefore, we only calculate interest for 11 months. So the amount of interest that should be eliminated for consolidation purposes amounts to 17,325 Rand. So 17,325 has been recorded by both companies. All right. Value Limited would have included it in its other income, okay, which is not shown separately in this case. We are only given the profit before tax amount, and Rancho Limited would have included the interest of 17,325 as part of its finance costs because they have paid the interest to Value Limited. So in order to eliminate the intergroup interest on this loan, we need to debit or decrease the profit before tax amount of the company that received the intergroup interest amount. In this case, it was the parent, Value Limited. Okay, 17,325. And we need to increase the profit before tax amount. Okay, let me just show how you would normally do this. Okay, let me first show you what you would have done if they gave you other income and finance costs separately. Okay, so normally you would debit other income of Value Limited, right, by 17,325, because once again, remember that they have included the intergroup interest in their other income. Okay, they would have received the interest, and we need to credit finance cost or interest paid by Rancho Limited, 17,325. So this is how the journal entry would normally look. All right, if all the income and expense items were given separately or were shown separately on your given trial balances. Okay. However, in this question, they have not shown the income and expense items separately. Okay, they have only given us the profit before tax amount for each company. So therefore, we will make use of profit before tax for each company. So we will debit the profit before tax amount for Value Limited. So what we are doing here is that we are decreasing other income for Value Limited. And if you decrease the company's other income, you will actually decrease its profit before tax amount. All right, so that is just for confirmation. and then you will credit the profit before tax for Rancher Limited. Because according to the second part of this journal entry, which I have shown right here, if we credit interest paid by Rancher Limited, we are decreasing the actual interest or the finance costs incurred by Rancher Limited. So because we are decreasing the interest expense, we are actually increasing the profit before tax amount for Rancher Limited, which is why we can credit the profit before tax for Rancher Limited by 17,325. Alright, so this is how it should look in terms of this question, and also in respect of the amounts given. But if they have shown the income and expense items separately, you would have debited other income for Valley Limited, and you would have credited interest paid for Rancher Limited. Alright, so please make sure that you understand how this journal entry works by listening carefully to that explanation that I've just given. Alright, this one was not too difficult. You just had to calculate the intergroup interest, taking 11 months into consideration, not the full year, because once again the loan was not concluded on the 1st of October, it was concluded on the 1st of November 2021. And the interest has been recorded by both companies. So therefore, it is included in the profit before tax amount of Valley Limited as well as the profit before tax amount for Rancher Limited. Okay, so we are done with number A, 3.5 marks there. Let's look at number B. Now, number B says that we have to eliminate the unrealized profit on the sale of machinery as well as the current year's depreciation relating to the machinery. Okay, because normally they would request you to eliminate the total unrealized depreciation from the date of sale up until the end of the current financial year. But in this case, they only required us to eliminate the current year's unrealized depreciation along with the unrealized profit. But for the sake of completeness, let us eliminate the unrealized profit first, and then we will eliminate the total unrealized depreciation from the date of sale up until the end of the current financial year. Alright, now the elimination for, or the information rather, for number B is given in additional information point 4. Okay, here they have swapped it because number 3 would be used for number C. Okay, the elimination of the intergroup dividends. So let us go to additional information point 4, which says the following. Now, in order to raise additional cash, Rancher Limited, the subsidiary, sold machinery to Valley Limited on the 1st of April 2021. Okay, please take note of the date of sale, the 1st of April 2021. It falls within the previous financial year. So therefore, we have to make use of a retained earnings account in order to eliminate the unrealized profit as well as the unrealized depreciation in respect of the previous period. Okay, so please take note of that. The machinery had a carrying amount of 105,000 and was sold for 150,000. So clearly we are dealing with an unrealized profit because the machinery was sold for more than its carrying value. So therefore a profit was made on this intergroup sale. Valley Limited calculates depreciation at 20% per annum using the reducing balance method. Now, why is the method important? Because it will affect our calculation of the unrealized profit. If it is reducing balance, and you will also see this in previous lessons that I have shared, if we are using the reducing balance method in order to calculate depreciation, okay, when you calculate unrealized depreciation that you need to eliminate for consolidation purposes, you first have to calculate the unrealized depreciation in respect of the previous period. All right. Once you have calculated the unrealized depreciation for that period, you need to take the amount that you have just calculated and then subtract this from the unrealized profit when you are calculating the current year's unrealized depreciation. Okay, that is the importance of the reducing balance method. If you are using the straight line method, you just calculate unrealized depreciation right from the date of sale up until the end of this year. All right, using the unrealized profit or loss amount. All right, so let's first calculate the unrealized profit that was made on this transaction. So the unrealized profit is calculated by taking the amount for the consideration or the proceeds on sale, which was 150,000, and we will then subtract the carrying value of the machinery on the date of sale, which was 105,000. All right, this will give you the unrealized profit, which is equal to 45,000. Okay, so how do we eliminate unrealized profit? Now, because a profit was made, we need to decrease the retained earnings account of the company that made the profit. Why do we use retained earnings? Because the transaction occurred in a previous period. If the transaction occurred in the current period, you would make use of the profit before tax amount, okay, or other income, because then the profit would be included in the company's other income amount. Okay, because in this case it was made in a previous period, we will need to make use of retained earnings. Okay, so because we are eliminating an unrealized profit, we need to decrease, so in other words, debit the retained earnings account of the company that made the unrealized profit. And in this case, it was Valley Limited, or Rancher Limited rather. Rancher Limited sold the machinery, okay, which is 45,000. Okay, the amount for the unrealized profit is 45,000. And keep in mind that the unrealized profit amount of 45,000 Rand would be part of the plant and machinery carrying value in Valley Limited's records. Because remember that Valley Limited would have recorded the value of 150,000 as the cost of the machinery that was purchased from Rancher Limited. So in other words, the profit of 45,000 is included in the carrying value of plant and machinery as shown in Valley Limited's records, which is why we will credit plant and machinery for Valley Limited, because we are eliminating the unrealized profit that is included in the plant and machinery of Valley Limited using the amount of 45,000. Okay, so we are done with the first part of journal entry B. Okay, we have eliminated the unrealized profit, but now we need to eliminate the current year's unrealized depreciation. But for the sake of completeness, we will remove all unrealized depreciation. So also the unrealized depreciation in respect of the previous period. How do we calculate that? Now, because we are using the reducing balance method, we need to calculate first the unrealized depreciation in respect of the previous period. Okay, so the previous period would be from the date of sale, which was the 1st of April 2021, and the previous period has ended on the 30th of September 2021. All right, so this will give you, let me just determine this, so it's April, May, June, July, August, and September. So this will give you a total of 6 months. All right, so the unrealized depreciation in respect of the previous period is calculated by taking the value of the unrealized profit, which is 45,000. We will multiply that by the depreciation rate, which was given as 20%, according to additional information point 4. And we will multiply that by 6/12, because we are calculating depreciation for 6 months, from the 1st of April to the 30th of September of 2021. Okay, this will give you a value of 4,500. So this is the amount of unrealized depreciation for the previous year. Okay, and then we are calculating the current year's unrealized depreciation. So for the 1st of October 2021 up until the 30th of September 2022, We will calculate that. Once again, we are using the reducing balance method. So we need to take the unrealized profit of 45,000 and we need to subtract the unrealized depreciation in respect of the previous year, which we have calculated to be 4,500. Okay, the difference between these two will then be multiplied by 20%, which is the depreciation rate. And you should arrive at an amount of 8,100. All right. Let me just confirm this. Yes, it is indeed 8,100. So the total unrealized depreciation that we are eliminating is 4,500 plus 8,100, and this will give you 12,600. Let me just make sure. Yes, it is indeed 12,600 Rand. Because remember, we have changed the required section in terms of Journal Entry B. We are eliminating the unrealized depreciation from the date of sale up until the end of this year. However, in this exam paper, they only required you to eliminate the current year's unrealized depreciation. But you first had to calculate the unrealized depreciation for the previous year in order to calculate the amount for this year, because we are using the reducing balance method. Let me just show you if the straight line method was used. So if we used the straight line method in order to calculate depreciation, the unrealized depreciation would then be calculated by taking the unrealized profit of 45,000 multiplied by the depreciation rate, which is 20%, and then we will multiply by 18 over 12. Okay, once again, from the 1st of April 2021, the date of sale, up until the end of this year, which is the 30th of September 2022, will give you a total of 18 months. And if you use the straight line method, this is how you would calculate, or would have calculated, the unrealized depreciation that will need to be eliminated. So then you would have gotten an answer of 13,500. Okay, so this would have been the unrealized depreciation that you would need to eliminate in total if you used the straight line method. Okay, and because this is the total that you are eliminating, you would need to split this between the previous period and the current period. So then if you use the straight line method, the previous period would still be 4,500. Okay, how do we determine that? The same way that we have calculated it here, taking the unrealized profit of 45,000, multiplied by 20%, multiplied by 6 over 12. All right. Another way that you could have calculated this is by taking the total of 13,500 and multiply by 6 over 18. We use 6 because we are calculating depreciation for 6 months, okay, the previous period. 18 is the total number of months for which the total depreciation was calculated. Okay, you would also arrive at 4,500. And then for the current year, you would have gotten 13,500 times 12 over 18. Okay, an alternative calculation would be just taking the 45,000 multiplied by 20%. Okay, you should arrive at the same amount using both calculations. Okay, and you would have gotten 9,000. Okay, so remember, this is not the official calculations for this question, or these are not the official calculations for this question. It is just for the sake of showing you how you would have calculated the unrealized depreciation if you used the straight line method. Alright, but we are concerned with these amounts that we have calculated because we are using the reducing balance method. So the journal entry would be, now because of the unrealized profit that was made, Valley Limited, the company that purchased the machinery Intergroup, provides for too much depreciation in its own financial records. Alright, the exact opposite will apply if a loss was made. In the case of an unrealized loss, the company that purchased the machinery would have provided for too little or insufficient depreciation. Alright, so it's very important that you distinguish between an unrealized profit and loss, because if you do not distinguish between those two correctly, you will your journal entry to eliminate unrealized depreciation would be incorrect. Now, in this case, an unrealized profit was made, so therefore the company, or Valley Limited in this case, provides for too much depreciation. So we need to decrease the total depreciation that they have provided for. And we will do that by decreasing their accumulated depreciation. Okay, so we will debit accumulated depreciation for Valley Limited, because that is the company that provides for too much depreciation due to the unrealized profit that is included in its plant and machinery. And the amount that you will use here would be the total amount from the date of sale up until the end of the current financial year, and we have calculated that to be 12,600. Okay. Now, there are two accounts that need to be credited. Firstly, we need to credit retained earnings of the company that sold the machinery Intergroup. Okay. And the company that sold the machinery is Rancho Limited. And the amount that you use here is 4,500, because that is the amount for unrealized depreciation in respect of the previous year. Okay, so the unrealized depreciation for the previous year is eliminated against retained earnings, and the other account that will be credited is normally depreciation, so the depreciation expense, also of the company that made the unrealized profit. But since we are not shown or given the expense items separately, we will make use of profit before tax. Okay, so normally you would use depreciation, okay, in order to eliminate the current year's unrealized depreciation. But if the depreciation is not shown separately, or other expenses is not shown separately, you will make use of profit before tax. Okay, both will be marked correct. And in this case, it was Rancho Limited. Okay, and the amount is 8,100, because that is the unrealized depreciation in respect of this year. Right, it's very important that you get this correct. Both of these should give you 12,600. And just to emphasize my previous explanation regarding the straight line method, if we use the straight line method, the amount debited to accumulated depreciation, let me just correct this, depreciation. So if we use the straight line method, the 12,600 would change to 13,500. Okay. The amount credited to retained earnings of Rancho Limited would still be 4,500. Okay, the unrealized depreciation in respect of the previous period. But the amount that would be credited to depreciation or the profit before tax is 9,000 Rand if we used the straight line method. And can you also see that this makes sense? All right. What we are actually doing here in this component, right here, or with this component, is that we are decreasing the depreciation expense of the company that sold the machinery Intergroup. And because we are decreasing an expense, we can also say that we are increasing the profit before tax amount. So if you make use of profit before tax, that is still correct, because by crediting the profit before tax amount, you are increasing the profit before tax amount. Okay, through the reduction in depreciation expense. All right. Okay, we are done with additional or point B, or journal entry number B. Okay, giving you a total of 7 marks. And this is normally one of those pro forma consolidation journal entries that they ask in 99% of pro forma consolidation journal entry questions. So please make sure that you know how to eliminate an unrealized profit or loss on the sale of a depreciable asset. as well as the related unrealized depreciation. Okay, there are quite a few examples in Learning Unit 7 as well, which addresses the elimination of the intergroup transactions. Okay, then the final journal entry that we are required to draft is the elimination of the intergroup dividends, as well as recording the non-controlling interest share in those dividends. Now, the information regarding intergroup dividends can be found in additional information point 3, which says the following. Now, Rancher Limited has been focusing on growth and expansion and as such did not pay any preference dividends since acquisition. Now, what is the date of acquisition? Now, the date of acquisition would be part of your general information, which is given before the trial balances. And if you scan through the information here, you should take note of the 1st of October 2019. So the 1st of October 2019 is the date on which Valley Limited acquired shares in Rancher Limited, okay, as part of its own growth and expansion strategy. So the 1st of October 2019 is the date of acquisition. Alright, so the subsidiary Rancher Limited has not paid any preference dividends since acquisition or since the 1st of October 2019. Alright, now all outstanding preference dividends, including the current year's preference dividends, were declared and paid at the end of the current financial year, which was the 30th of September 2022. No ordinary dividends were declared or paid by either company during the current year. So in other words, we only need to provide for the elimination of preference dividends, okay, that were paid intra-group, and we also need to record the NCI share in that amount. Okay, now before we can actually, okay, how am I going to do this? Okay, let's first calculate the value of the total preference dividends that were paid by the subsidiary. Okay, let's first do that. Then I'll come back and calculate the percentage interest of the parent. Okay, so the total preference dividends declared and paid by the subsidiary, which is Rancher Limited. Now, the value of the preference dividends will be calculated by taking the value of the cumulative preference share capital of Rancher Limited. So it will be this amount given here, the 100,000. All right. Then we will multiply this amount with the depreciation, or not the depreciation rate, the dividend rate, which is 12%. And keep in mind that in Factor 602, we will assume that the preference shares are cumulative. Okay, so what this means is that if we do not pay the preference dividend for this year, okay, so let's say we do not declare a dividend for this year, all right, the preference dividend for this year must then be carried forward to the next year up until it is eventually paid. All right, so what this means is that if we do not declare a dividend for this year, we will not forfeit, or the shareholders will not forfeit the dividend. It just means that the dividend is carried forward up until it is eventually paid. All right, so what I'm trying to say here is that we need to calculate preference dividends not only for this year, but for all those years since acquisition for which the preference dividends were not declared and paid. All right, so in other words, we need to take into account the period from the 1st of October 2019, which is the date of acquisition, up until the end of this year, the 30th of September 2022, when calculating the total value of preference dividends paid. So in other words, we will multiply this answer by 3, because from the 1st of October 2019 to the 30th of September 2022 will give you a total of 3 years. Okay, so you cannot just consider the preference dividend for this year. Okay, the preference shares are cumulative, so the preference dividends that have not been declared and paid in respect of previous periods were also paid in the current financial year. All right, and you should get a value of 36,000. So 36,000 Rand is the total value of preference dividends that were declared and paid by Rancho Limited. If you go to your trial balance, this should be the amount disclosed here, okay, or represented by the question mark. Okay, dividends paid. Once again, please note that no ordinary dividends were paid during the year. So the full or the total for dividends paid only includes preference dividends. Okay, you do not need to worry about distinguishing between preference dividends and ordinary dividends in this question, because only preference dividends were paid during the year. All right. Now we need to split this amount between the parent, Valley Limited, because the parent is a shareholder of Rancho Limited, as well as non-controlling interest or your minority shareholders of Rancho Limited. So in order for us to determine that, we first need to calculate the parent's percentage interest in the preference share capital, not the ordinary share capital, the preference share capital, because we are working with preference shares. All right. So in terms of preference share capital, the percentage interest of the parent is calculated by taking the number of preference shares owned by Valley Limited. In this case, it is 20,000 shares. All right. You will find that as part of the investment in Rancho Limited. So the parent owns 20,000 preference shares out of the or the 50,000 rather. So the parent owns 20,000 out of the 50,000 issued preference shares of Rancho Limited. Okay, this will give you a 40% interest. Okay, now remember that this one can be less than 50% because it is in terms of preference share capital. However, for your ordinary share capital in FAC2602, the parent must have a majority shareholding in the subsidiary in order to have control. Okay, because in FAC2602, only the ordinary share capital is considered in determining whether the parent has control. Now, just for the sake of completeness, if we calculate the percentage interest that the parent has in the subsidiary's ordinary share capital, it will be calculated in the same manner, taking the number of ordinary shares owned, which is 240,000, divided by the number of ordinary shares issued by the subsidiary, which is 300,000, and you will multiply by 100. This will give you 80%. So in terms of ordinary share capital, the parent has an 80% share in the subsidiary, which means that the parent has control over the subsidiary. Because according to additional information point 1, we need to assume that each ordinary share carries one vote and that voting rights alone determine control. So only the ordinary shares are considered in determining whether the parent actually has control. So in a nutshell, when calculating the percentage interest of the parent in the subsidiary's preference share capital, the parent's percentage interest can be less than 50%. Okay, in terms of preference share capital. But if you calculate the percentage interest in terms of ordinary share capital, the answer that you get there should be more than 50%. Because only then will the group actually be formed because of the parent having control over the subsidiary. Okay, please listen carefully to that explanation. So if the parent has a 40% share in the subsidiary's preference share capital, the NCI or the non-controlling interests would take up the remaining 60%. And these are the percentages that we will use in order to calculate the intergroup preference dividend, as well as the preference dividends that were paid to non-controlling interests. So you cannot use the percentage interest of ordinary share capital in order to split the preference dividends between the parent and non-controlling interests. Okay, you are working with preference dividends, so you need to use the percentage interest for preference share capital, okay, for the parent and non-controlling interests. If we dealt with ordinary dividends, we would use the 80% that we have calculated versus the 20% for non-controlling interests. All right. So the amount that goes to value limited is 40% of the total, which is 36,000, and therefore it is 14,400. So this is the amount of the intra-group preference dividend that was paid to the parent, okay, or by the subsidiary to the parent. And because this is an intra-group portion, we need to eliminate that for consolidation purposes. All right, as I've said, the non-controlling interest would take up the remaining 60% of the total preference dividends declared and paid. So therefore it is 21,600. So this is the amount paid to non-controlling interests, and this will be the amount that was paid intra-group to Value Limited. So if you go back to your trial balance, Value Limited would have included the amount of 14,400 as part of its profit before tax, okay, or other income. Okay, so now we can eliminate the intra-group dividend as well as record the non-controlling interest share. So we need to debit other income for the parent, which is Value Limited, and we will do that by debiting profit before tax because other income is not shown separately. Okay, the amount that we will use here is 14,400. That is the value of the intra-group preference dividend. We need to debit non-controlling interests, all right, by 21,600. So why do we debit non-controlling interests? Because this amount of 21,600 is not owed to non-controlling interests. So in other words, it would decrease the value of non-controlling interests that you would show on the face of the statement of financial position or the consolidated statement of financial position. So by debiting non-controlling interests, you will decrease the amount that will be shown here. Okay, it just indicates that you have paid or declared that amount to non-controlling interests. All right. So this will be shown in your consolidated statement of changes in equity as well, right here. Dividends declared and paid preference. So this will be shown like this. Okay, this is how you will show the preference dividends paid to non-controlling interests. All right, because non-controlling interests normally has a credit balance on the consolidated statement of financial position. All right, and then let me just go back to my journal entries, and the account that we will credit is dividends paid, because according to our trial balance, this will have a debit balance or a debit total. And since we are eliminating the intra-group preference dividend and recording the NCI share in that dividend, we need to reverse or credit dividends paid by Rancho Limited with the total amount that we have calculated as 36,000. Okay. Only these pro forma consolidation journal entries were required, so please do not waste your time on recording other journal entries. Okay, very good. Alright, ladies and gentlemen, that is all for this lesson. In the next session, we will work through question 2, which addresses the group financial statements. Once again, for the sake of ensuring thorough exam preparation, we will draft every consolidated financial statement in full, even though only certain columns or statements have been requested in the exam paper itself. Okay, we will work through all the consolidated financial statements to ensure thorough exam preparation for the 23rd of January 2023. Alright guys, I'll see you in the next one.